everyone, this is Kathy and Thomas, and we're going to bring you up to date as we're halfway through 2025. My goodness, did that seem fast?
Time flies, halfway through the year.
A little too fast. So we started the year pretty well with everything. Optimism, markets were great. Then we hit the Trump factor, and here we are now. So Thomas, if you will, how did we fare this first part of the year? It's a bit of a back and forth, right?
It has been a little bit of a back and forth, but now we have just about 2 months after Liberation Day in the States. We've seen now all of our portfolios turn positive now. It's been a lot of volatility, but in our mind, it's great. It's buying opportunity. So we took our wish list of what we wanted. We always have our eyes on things that we're looking to pick up at cheaper prices. So it was a busy April and May for us, but we took advantage of lower prices in the market, and we were really able to work in new clients and their money. And we did Kathy's, as you guys know, as being a long-term clients of Kathy's, or cash calls. So we went reaching out to people who has money to put in right now, and usually we're pretty happy with our buy points. We're a little unsure about when those prices are going to come and appreciate. It ended up happening pretty quickly, so we're happy that we were able to move quick and do a lot of buying here in the past couple months.
It seemed to be the year started quite well right off the pop. We had great returns, and then we hit Trump and tariffs, and the tariffs were the uncertainty, and it was all over the map. And I recall a quote probably a month or two ago when Mr. Trump was asked, how are you determining these tariffs? And he responded, by his gut, and the market tumbled. So social media feeds that weren't accurate, not verified, the market went up almost 10%. When they were verified to be untrue, the market went down 10%. So a great amount of volatility, which we've seen before, but not all in one day.
Yes.
So it was pretty crazy. Thomas was trading one day because, as you know, we're contrarian. And when the markets go down and it's tough to buy and you're fearful, and is the world going the wrong way, and oh my goodness, you know, that cycle that we get in, that is the absolute best time to buy. And we buy really good stuff. So Thomas came into a meeting back then during those days, and it was just after 2, and he just finished buying, and he's buying live, and he looked a little shaken.
A little
I think your hair was on fire.
It might have been. It might have been. Yeah.
Yeah, but those prices. We just met with a client this morning. A newer client came in last fall, and of course it was a little bit scary for him. But his returns now, he is smiling. So how does this? Maybe the uncertainty is our new normal, and we're getting used to it. I think that's part of it.
It's the old adage, be greedy when others are fearful, and fearful when others are greedy. So when we saw the fear in the market and we saw some irrational selling, we used that as an opportunity to pick up some of their names that we liked, and as Kathy mentioned, nothing too crazy, but it's a lot of value and things that we had on our wish list. If you like a stock at $100, you're gonna love it at 80, and that's what we saw in April. And now we're back up, sitting close to all-time highs again in the market.
So I've kind of lost track, because when I look in the morning, not so much now, mid-year, but say a month and a half ago, when I looked in the morning, markets are down. I looked at lunch, markets were up. So it's very erratic. We seem to have reached a little more calmness. And so where are we now? How are we in Canada? What are we year to date? How about international, global? Like, where are we at this moment in time?
This year's a great year to remind ourselves of why we keep balanced. I think a lot of years past, you hear a lot of investors wanting to be overweight in the U.S. And this year's it's really paid off for us keeping diversified. As of today in Canada, we're up about 7%. States is just crept up to break even, just about 2% positive this year. But international's been the big winner, being up about 15% as of filming here today. That's the reason why we keep balanced, keep diversified, and we keep adding to those names, not getting too overweight in one certain sector or one economy. We remain balanced, but this year the big winner has been the international trade.
Yeah. Now, we always love when the markets go down, we like to buy really good quality positions, stocks, ETF, mutual funds. And I've noticed in our asset allocation that we broadened out Canada a little bit, which is, this means that you're a little bit more of a risk adverse investor. Maybe you're getting closer to retirement. Maybe it's a tax call where dividends are better than interest. So we've seen a bit of widening out in that position, and that's really served us well.
As
Other sectors, you're really enjoying the U.S. mid-cap.
Yeah.
Tell me about that.
the mid-cap trade has been a spot that we've seen a lot of value in. Over the years, with U.S. exceptionalism, people have really poured into the U.S. market. And one thing that I'm sure everyone's heard in the news is the amount of concentration in the U.S. market. 7 names making up 35% of the S&P 500, the big index in the States. So where we look at with this administration is, as Kathy likes to refer to, where's the puck going? And we always are looking, where's the puck going? Where's value? And we saw that with the mid caps and the U.S. mid caps. So they're a step below the largest companies in the States. They're mid-sized companies, and for us, we really enjoy those companies. We believe that with this administration, we expect to have some corporate tax rates that being cut, which will help those companies. And we also like buying them at lower multiples, lower valuations, cheaper, instead of buying technology names at 25, 30 times earnings, which is quite rich in some cases, depending on how they're able to grow those earnings. We like to buy a lot of the mid-cap names, which tend to trade around 10 times earnings, which is below where the broad U.S. market trades, which is usually about 18 to 20 times earnings. So we're buying cheap, we're buying these smaller, more nimble companies. And a big theme in the States has been, especially with J.D. Vance, is he's mentioned a lot of antitrust, a lot of breaking up these bigger companies. So we really see the opportunity for the small business, the mid-sized businesses to flourish. And as investors in new capital comes into the market, money managers like ourselves are looking to continue to allocate cash, and we see people starting to move down the company size and to look for those growthier names, which we see as being the U.S. mid caps.
And I think there's just a general feel, definitely in that government, of bring it on home, buy American, and that's certainly where your medium-sized capitalization companies are going to flourish. Yeah. So that's where we see that. With all this turmoil and all this anxiety, there's always the flip of the coin. There's always yin and yang. With all this turmoil in the U.S., what's happened as a side result is that it's created some very good positive situations around the globe and in Canada. Look at, we're just coming off the G7 in Kananaskis, so that'll ruin my highway to the mountain with traffic. But they're all, you can see a very big sense of collaboration. Yeah. People are trying to work with Carney. They realize this is quite a situation. And we're seeing, call me optimistic, that maybe some of those provincial trade barriers will fall. And this is dumb because the tariffs on provincial boundaries are as bad as the U.S. tariffs. So we're tariffing ourselves. Yeah. So can we hope, can we be optimistic? I heard that Nova Scotia, PEI, Ontario are all, we're in, and the barriers are dropping already. Yeah. And if I might quote PEI, they said at one of the Premier's meetings, whatever is good for Alberta is good for PEI. Like, have we ever heard this before?
I don't think we have,
Wow. Yeah. So a client asked me the other day, he said, do you think Trump will follow through with all the things he's trying to do, and will he be successful? Now, what a question that was. Yeah. And I said, well, I think he's got a couple of good things. He's eyeing pharmaceuticals, processed food, which the U.S. really needs something dramatically to change. 73% of food in grocery stores, because we can't call them food stores anymore, are processed. Yeah. So that could be helpful to heal the medical system in the U.S. But also, we can't really see a crystal ball what's going to happen there, but Trump has been proven to lower those corporate taxes, which keeps him in favor with all his friends. But in turn, we're responding in a way that's very positive. So we can control how we respond. For example, buying low when he causes our market to be in disarray, and our government actually stepping forward and getting something done, our provincial and our federal. So call me optimistic.
Midterms are coming up next year, and what we do know is that the stock market is another big consideration when people head to the polls. If people take a look at their statements and they see their retirement down 20%, they see cost of living continuing to rise, then those would be considerations that Americans take into account when they go to the polls. Trump is incentivized to hopefully to increase and to make America a great spot where capital continues to flow in. He got handed the keys off from Biden when the market was at all-time highs, and it wouldn't look the best on him when he gets to his halfway point in his administration. If the market was meaningfully off from those levels, he's going to be incentivized. We know that he's been pushing Jerome Powell to cut interest rates, trying to bully him in some ways. But what we do know is that Jerome Powell's term is up next year, and we're going to have a very pro-Trump individual coming in there for the next term. But there's going to be a lot that's going to happen between now and the midterms. But we really think that it's in Trump and America's best interest to try and ease everything in the market, and it would look a lot better for the Republicans if things were a little more positive, a little more certain and stable this time next year.
You can certainly see it in our graph charts. You can see, for example, going into COVID, the big dip down, then the rise with us all online shopping, et cetera, then the drop when Russia invaded the Ukraine, back up a little bit with Gaza and that horrible situation, and then Trump. It's just like dogtail down. So it's very clear and very dramatic. So Trump continually comes up with new things, some good things, some bad things. And speaking about taxation, he has come out just recently in the last couple of days with looking at foreign entities doing business in the US. So Canadian corporations, for example, and Canadian property. He's looking at increasing the withholding tax in that situation. I don't know if you have a property in Hawaii or Phoenix, Scottsdale, you're holding it in your corporation, this is a bit ominous. And this might, as we've seen with our clients that do have properties in the US, wow, they're selling them left, right, and center. Phoenix, Scottsdale, Palm Springs, Florida. I think the US underestimated the amount of time that Canadians spend in the US and the amount of money we spend. So on the other hand, he's trying to extend substantial presence that you can stay there longer, but he's after our money. I just got a 1 or 2 liner on that, so we'll see how that develops, and that would cause a lot of properties being sold, that's for sure, and maybe some corporate considerations. But on the other hand, what Trump has done is he's very much eyed energy. He's pro-energy, and in particular, quote unquote, he has dictated that nuclear energy should quadruple. He hasn't given it time, and we love that nuclear energy area, that sector. We've been very successful with it. It's medium high in risk, so you have to approach it with that thought. But there is a position that's performed really well for us Canadian. Well, everything's performed well with us.
Similarly in Canada too, people have been putting a lot of attention and focus on cleaner renewable energy, and we've seen a lot of traction with that in the States and also up in Canada. It seems like everyone from Trump's big beautiful bill has gotten some love, except for his partner, or his old partner in crime, Elon Musk. We're seeing now a lot of money going to EVs, but as Kathy mentioned, a lot of focus and attention going into renewables and especially nuclear energy.
And the big deal, of course, is portable nuclear. And that you can get it up north, you can get it to smaller areas, smaller communities. And as we all know, artificial intelligence pulls tons of power. So you're going to see an AI site and a nuclear reactor right beside it, because that's what you need to do to power it. You mentioned Jerome Powell. The Bank of Canada held steady last week at 2.75. they're just trying to feel their way with all this uncertainty, so they want a little room to lower if need be. CRA, let's just talk about tax time. CRA was a challenge this year, as all our accountants know. CRA didn't have T-slips posted on their site. Their level of ability to answer service calls was extremely limited. So I'm hoping Carney turns his eye on that particular department, because we're finding the service challenging, and I think that's an area that could be really helpful. Not to mention what they did with the capital gains inclusion from last year. Yeah. They actually had it didn't get passed, they were going to enforce it anyways, but on old paper tax returns, the inclusion increase was on the old tax returns. They had full intention of collecting that tax money. Of course, one of Carney's first moves was to throw out the carbon tax and the capital gains inclusion, which was a good move. Yeah. He's also come up with something interesting. I just caught this on the weekend, that he's looking at, if you're buying a new home and it's under $1 million, that's our benchmark now, scary. If it's a new house, a new build, to eliminate the GST. And I thought that was a very interesting, creative way to get first-time home buyers into houses.
Yeah, it's a big chunk of money, $50,000 on $1 million buy.
Yeah,
it's a lot of money that's going to go and help and leave more cash in the pockets of Canadians. So if it goes through it, that would be very beneficial for our first-time home buyers. That in collaboration as well with our first-time home savings accounts that came out as well. So hopefully these bills continue to pass through and make like a little more affordable for those in Canada.
Just on a interesting note, I was out of the country in the Caribbean in April, hung up my skis, went to a beach in St. Lucia, and that resort was so busy. I said, is it busy with more Canadians? And they said, yes. And I asked them why, and they said, we don't know, but we've had such an influx of Canadians. So back to, where are we spending time? Where are we spending money? Canadians are going elsewhere. And this is enhancing travel in our own country, in Europe. Definitely warm places like Hawaii have lost favor. We're in the Caribbean now and further, South America all through. And last I heard, Vegas is a ghost town, so they're calling you and emailing you with great deals. So I guess Canadians that pop down to Vegas for 4 to 5 days, see some shows, maybe play some cards. I don't gamble. I don't want to lose money. I don't want to lose your money in particular. We never gamble. So I'm kind of allergic to it, but money is going to Europe. So different areas are being stimulated, and we're keeping our eyes on that for your benefit. So we're looking at, in summary, we're looking at increasing international. We're loving nuclear energy in proportion, U.S. mid-cap.
Yeah.
And any of the low volatility funds, we're getting great performance out of those babies.
The low volatility funds have been tried and true for us, and it's been a great spot that's held up during times of market turbulence, and a spot where we actually have a pool, if need be, where we can trim from and add more into other equities as well. But for our retirees, people who are looking to keep investing in the stock market but don't want to take the same ride, it's been a great alternative for us. And depending on which ETF you use, a lot of them have about half the volatility of what the market has, and then still the ones that we have been buying and looking into and doing our due diligence on have had very similar return profiles to their underlying index, but it's taking on a lot less of a bumpy ride. We like to tell clients, and a lot of our clients like to take the escalator ride up versus the elevator rides, and it just helps smooth that out. And both of them this year have done very well. A lot of money managers continue to look for spots to deploy capital. Don't really feel like that there's the same risk reward opportunity there with the big technology names, but they still need to be able to allocate capital somewhere. So we've been seeing a lot of money rotate into those lower volatility sectors like consumer staples, your utilities, anything that would be the last to go away in times of turbulence or a recession. Your insurance providers, your Home Depots, your Walmarts, those are all the companies that would be in those ETFs, and they've performed really well during times of uncertainty.
So we're busy. Right now we're in the midst of, with Pam's dilemma's help, reviewing tax returns. We know that tax time, accountants are exhausted, they're busy. So we're just taking a look-see at your tax returns, ensuring that we're very tax efficient and that you got everything you deserved on your tax return in the way of a refund or a deduction. So as with everything, don't hesitate touching base with us. We're here for you. You're highly valued and we're honored to serve you. Bye for now.